Welcome to GraceKennedy's Investors Briefing on our annual report for 2017. My name is Don Wehby, Group Chief Executive Officer. With me is Mr. Frank James, Group Chief Financial Officer. We welcome all participants who have joined us via the internet for this audio conference. The briefing has been scheduled to run for 40 minutes. We will use 25 to 30 minutes of this time for presentations and the remaining time to accommodate your questions. During the question and answer session, you are welcome to share your questions by emailing us at gkinvestor@gkco.com. Let me repeat that, gkinvestor@gkco.com. You may also call or send a text to our communications team at 876-809-1121 or 876-809-0464. Let me repeat those numbers, 876-809-1121 or 876-809-0464. I will now do a brief presentation and then I'll ask Mr. James to expand on the financials for us. Well, good afternoon again, everyone. Let me say that the GraceKennedy Group for 2017 had a very successful year despite many challenges. Our revenue for the year was $92.5 billion, an increase of $4.21 billion. Based on our strategic plans that we have in place now, we are projecting that the GraceKennedy Group will report revenues of over Jamaican 100 billion before 2020, and we consider that a landmark achievement. In terms of 2018, 49% of our revenue was generated outside of Jamaica and 51% inside Jamaica. You will recall, based on our vision statement as a global consumer group, we are projecting by 2020 60% of our revenue will be generated outside of Jamaica, and we believe that we are on track to hit that target of 60% of our revenue outside Jamaica, along with the target of 100 billion Jamaican dollars before 2020. In terms of net profits after tax, we reported profits of $4.7 billion, an increase of $237.2 million. Again, 44% of those profits were generated outside of Jamaica and 56% inside Jamaica. You recall our target by 2020 on a sustainable basis that 50% of our profits should be generated outside of Jamaica. Let me just speak a little bit about the challenges that we had for 2017. The first one, you recall that early in 2017, we had a ban on corned beef that resulted in a revenue shortfall of 500 million Jamaican dollars. I am happy to say that at this time we are seeing a recovery of the corned beef market at the latter part of 2017 and the first 2 months of 2018. While we are not back at the original level, we are happy with the pace of recovery. In terms of the hurricane, we experienced losses due to the hurricane. As you know, GKI, we are in the Caribbean, and we had losses resulting out of the hurricane, and Frank, I'm going to ask you to expand on that. Also, you recognize that as an international company earning 44% of our revenue, our profits outside of Jamaica, the revaluation of the dollar at the latter part of 2017 actually affected our revenue and by extension our profitability. We also increased our compliance measures from August 2017 through our Western Union network. We are in agreement with Western Union. 10 locations were actually suspended, ranging from Mobay and throughout the island. I'm happy to say that after significant due diligence, of the 10 locations, 8 were reopened in December, and as we speak, all 10 are back in operations. That would have affected our transaction count coming into Jamaica, but as I said earlier, all 10 locations are up. So you'd see over the years, GraceKennedy Group, in terms of innovation and sales strategy, we have in fact been doing a good job in terms of growing the revenue through acquisitions, through new products, through new services. We have recognized that, Grace, that we're in a changing environment, and we have to look forward, and we must ensure that the company is structured in a very agile way, a very efficient way, and a high-performing corporate headquarters. We are now actively involved in an exercise to deliver on those objectives of becoming a much more efficient company, and by extension, a much more profitable company. I will report to our shareholders at the AGM on the progress that we are making in terms of that exercise. Another highlight for us for 2017 was the acquisition of Consumer Brands, which we acquired during the year. Consumer Brands has been outperforming all our expectations. The revenues are significantly up, and the profitability flowing to the GraceKennedy bottom line is also significantly up. If we look forward to 2018, we will continue to look at potential acquisitions for the group, both in financial services and in food, in Jamaica and outside Jamaica. We think that, given the Consumer Brands experience and the Grace Peppers experience, we believe that strategically, acquisitions in the group is a good growth strategy, and we're actively looking at potential acquisitions going forward, both in Jamaica and outside of Jamaica. For the financial services, we are focusing on Trinidad and Guyana to expand both our insurance and our banking services. One of the exciting projects that we have here at GraceKennedy, and we speak about it as innovation relating to technology, our GKG Online, which is our online insurance services through GKI, GraceKennedy Insurance, is performing exceptionally well, and the growth in that area of online services is very, very satisfactory. GKMPA has started out slower than we expected, but we're going to be adding new products to the platform, including a companion card, and we expect that to be launched by the second half of this year. High-Low, our supermarket chain, there's going to be an online platform, e-commerce, where you can stay in the comfort of your home or your office, order your groceries, and it will be delivered to your home. And I think that is going to be somewhat of a game changer for the retail food market, certainly in Jamaica. You would also recognize that our Grace products can be found on Amazon.com. So if your family or friends living as far as Australia, America, Canada, they can order our products online through Amazon.com. The other area that we are looking at is a platform where all your financial services can be done over the phone. We expect that to be launched in August of this year, where you can do your banking, you can do your insurance, you can do your money services over your mobile. This is going to be what I have described to my team and my colleagues as really revolutionary in the way financial services is carried out in Jamaica. It's going to be hassle-free, and I in fact showed it to our shareholders last year at our AGM, and I'm happy to announce that we are on track to launch that product that I demonstrated at the AGM. We are on track to complete our new corporate headquarters. We had budgeted US $25 million. We are at this stage, we are within budget, and we are expecting to complete the building by December 2018. I'm going to pause here. I'm going to hand over to Frank to get into some more details of the group's performance, and then we will be happy to answer any questions. Frank, over to you.
Thanks, Don. As Don indicated, our revenues were up 4.8% or 4.2 billion, totaling 92.5 billion. which meant that for the first time the GraceKennedy Group broke through the $90 billion mark. We're very pleased that we're able to do that in our 95th year. We saw 3 of our 4 segments showing growth in revenue, with insurance flat and slightly up, while money services was the only segment that was down in revenue. Our net profits up 5.2% or $237 million, reaching $4.8 billion. Now, shareholders and investors will note that pre-tax profits were down 4.7%, and these were impacted by a number of factors. Don spoke to some of them. I would also mention that in 2016, we had some non-recurring gains on the liquidation, as previously reported, of some non-operating foreign subsidiaries. That liquidation gain was more significant than on a pre-tax basis, on the gains on acquisition in 2017. When you combine that with the unprecedented impact of the 2 hurricanes, Irma and Maria, that would have impacted our 2017 pre-tax profits. In fact, if we adjust for those 2, our pre-tax profits would have been up 1% and net profits up 9%. And that would have been adversely affected by the other things that Don already spoke to, such as remittance locations and the ban on corned beef. So notwithstanding the challenges, we were able to grow revenue and net profit. And this really reflects strong operating performance for both our food trading business, which was up 17% in profits for the year, and our banking and investment segment, which was up 79% in profits for the year. Only one segment actually showed a decline, which was insurance, for the reason we mentioned before in terms of the hurricanes. The other thing that supported our after-tax profit position was tax credits of $416 million. Now, as you know, GraceKennedy was born in downtown Kingston in 1922, and we have remained committed to downtown Kingston and its development for 96 years. So in line with that commitment, we are investing over $3 billion in the construction of our new corporate headquarters. That investment comes with a number of financial benefits. One, it will allow us to rationalize our office space, so we will be seeing some of our subsidiaries vacating high-cost US dollar rented space in New Kingston and coming to the new corporate offices. But importantly, we'll also realize a number of benefits under Jamaica's Urban Renewal Tax Relief Act. And I just want to spend a minute telling you about those benefits. So one benefit relates to the capital investment that we make, which allows us to recover 1/3 of eligible capital investment in the form of tax credits. We are approximately halfway through the eligible capital investment, and in 2017 we were able to recognize $416 million in tax credits. We anticipate completing the construction in 2018, and therefore would recognize the additional tax credits in 2018. It also allows us to borrow on a tax-free basis, which lowers the cost of funding for the construction of the building. And then finally, any rental income that is generated by tenants that we may have in the building will be tax-free until 2026. And we do intend to have some tenants for the retail space. So we expect to see further tax credits in 2018 and additional benefits going forward. Looking at revenue in a little more detail, the largest contributor to our revenue growth was the food segment, with $3.8 billion of the $4.2 billion growth coming from the food segment. Jamaica actually outpaced the international market in terms of growth. Jamaica grew at 7%, or international markets grew at 4.5%. Don spoke to the challenge we had with corned beef, which impacted our revenues in Jamaica by over $500 million. But we feel very pleased with the performance in Jamaica because it reflects the resilience of our food portfolio, with products such as Vienna sausages, mackerel, frankfurters, and ketchup performing extremely well, a number of these delivering growth percentages in the high teens. We're also very pleased with the acquisition of Consumer Brands, which brought with it the strong line of Procter & Gamble products, and in just 4 months was able to deliver over $877 million in revenue, which also supported the growth of revenue in the Jamaican market. As you will see from the financials, it is a profitable business, generating over $82 million in net profit for the 4 months that we have the business in 2017. I had mentioned a one-off gain in 2017 as well related to Consumer Brands of $418 million. to explain that one-off gain, it indicates that basically when we do a valuation of our expected future cash flows of consumer brands, it exceeds the purchase consideration. Therefore, we see this as an acquisition that will be adding to shareholder value. Other revenue drivers for 2017 were high-low, notwithstanding the Barbican store impacted by roadworks. We saw high-low revenue growing. The addition of the Ligonese store has continued to help increase revenue for high-low. We also added other principal brands such as Lucozade, which also supported the revenue growth for the food business in Jamaica. In our international markets, we saw good growth from our U.S. business. In fact, as a single business unit, our company in the USA contributed the most to revenue growth, delivering 8% growth with both the Grace and the Lafayette brands growing revenue. Our food business in the U.S. also continued to show improved performance with some improved efficiency. Another star was our Canadian food business, which continues to do well. Revenues up 12% and improved margins also driving higher profits. The exception in our international markets was our UK foods business, which was down 1.5% on revenue, primarily due to lower sales of nourishment or milk-based drink, and that also resulted in a decline in profits as nourishment is quite a high-margin product for us. Moving to the financial services group, our banking and investment segment experienced good growth, revenue growth of 7% and profit growth of 79%. This was led by First Global Bank with loan growth year over year of 6.5% and a significant increase in the gain on sale of securities. We also saw a meaningful decline in the provision for credit losses as we continue to focus our efforts on effective delinquency management. Our investments in technology and our branch network have been paying off, and we have seen it being rewarded with our customer deposits growing, strong deposit growth of 9% or just under $3 billion year over year. Our financial inclusion push with the opening of FGB MoneyLink will also increase access and convenience to a wider range of customers and continue to drive growth for the bank. In our money services segment, our revenue was flat with profit growth of about 3.5%. Don already spoke to what impacted our money services revenue in Jamaica and profit in Jamaica, but we remain firmly of the view that while it will have a short-term impact on profits, ensuring the protection of our customers' money will be to the benefit of the business in the medium term. We must also speak to Guyana and Trinidad, which performed very well in the money services segment. Finally, on the insurance segment, our revenue was flat and our profits down 28%. And we spoke about the hurricane impact there already. Looking forward to in the insurance segment, though, we have started to see where premium rates are adjusting given the types of hurricanes that were experienced in 2017. And you will see that impact in revenue and profits in 2018. In terms of our balance sheet, our assets increased by 2.8% or $3.5 billion to just under $130 billion, driven largely by growth in receivables. These receivables are really our insurance recoverables from our reinsurers. So it's not reflecting a main concern in terms of receivables management, and that is timing as we pay off the insurance claims related to the hurricanes. Also, our loans receivable grew from FGB. Our fixed assets, you would also notice quite an increase in our fixed assets. In addition to our corporate offices, we continue to reinvest in high-low, as well as the central sorting office, where we have now leased for business process outsourcing purposes. These things would have affected our cash from investing activities, reducing our cash from investing activities. Another main change on the balance sheet is a significant reduction in pledged assets. To explain what that is, investment securities are used to back our repurchase agreements for our bank, and therefore we have some of our investment securities pledged to support the repurchase agreements. If you look on the liability side, you'll see that our repurchase agreements were down significantly. This was an intentional strategy by FGB to pay off higher cost sources of funds to improve our net interest margins. So facilitated by some Government of Jamaica redemption of bonds during the year, we were able to reduce our pledged assets, pay down our higher cost funds in repos, and also reflect that in higher investment securities as shown on the balance sheet. In terms of the liability side, that remains fairly flat because of the reduction in higher cost repos. On the other hand, we had strong growth in deposits from the bank and increase in payables. Again, this largely reflects the insurance claims and not any challenge repayables. And you'll note that we also increased our use of leverage, which we think is timely with interest rates being down. So our debt to equity ratio moved from 31.5% to 36.5%, still leaving more than adequate room for funding of future growth. Finally, on shareholder returns, we continue to invest for growth, investing over $3.5 billion in capital expenditure for the year. We balance this with a return to our shareholders in cash. We recognize the importance of returning dividends to our shareholders, and in 2017, our dividends per stock unit was $1.13, or just over $1.1 billion paid out to our shareholders. This represented an 11% increase. This month, the board declared a dividend of 40 cents per stock unit, up 33% over the corresponding period in 2016, a payout of just under $400 million, which will be made to shareholders in May. We recognize that with the increases in the stock price over the last few years, our dividend yield has been impacted, and as such, we are improving our dividend payout to our shareholders in line with that reality. The GraceKennedy stock price closed the year at $43.84, up from $40.29, an increase of 9%. That leaves our price to book ratio at the end of the year at 96% and our price earnings multiple at 10.6 times. We think this reflects significant upside for the GraceKennedy stock, given that when you compare that to the market multiples, both on a PE and PB basis, are significantly higher. We also saw the stock price closing yesterday at $46.54, which seems to indicate that the market is recognizing that upside potential, as the stock just for this year so far has already increased by 6.2%, outpacing the JSE main index, which is up 1.5%. Finally, the group's equity position continues to be very strong, growing by $3.2 billion to over $45 billion.
Right, thank you, Frank. Thank you for that very comprehensive report to our investors and by extension our shareholders on the performance of the group. All right, we're going to be taking some questions now. Frank, the first one is for you. Frank, there has been a lot of talk about IFRS 9 as it relates to the financial services sector. Can you say at this time the impact it will have on GraceKennedy and the preparedness of GraceKennedy to implement this new standard, IFRS 9?
Thanks for that question, listener. A very relevant question at this time. The GraceKennedy Group has been very proactive in preparing for the changes coming out of IFRS 9. We have had a team working on this since very early last year, and we are well advanced in being ready for its implementation for the first quarter reporting at the end of March. The main impact of IFRS 9 is in how we recognize impairment provisions, where we'll be moving from what is considered an incurred credit loss model to an expected credit loss model. What does this really mean? What it means is that once you have a book a loan or book some form of receivable, you will have to assess it right away to determine if there needs to be any provision against it. You won't wait until something happens to that loan or until there's some indication that there is something wrong with the loan or the receivable. So you will have situations where on booking a loan or on booking a receivable, we will be immediately making a provision against those loans and receivables. This is an industry-wide change, an international change, and we continue to finalize the implementation of that and expect to be ready for that for our first quarter reporting.
Thank you, Frank. This question is for me. Hilo, Mr. James just reported that Hilo actually showed an increase in revenue, which is quite surprising based on Barbican. Yes, thanks for that, listener. Our Barbican store, as Frank mentioned in his presentation, that we are severely impacted by the roadworks there. And our revenue for high-low Barbican is actually down by about 25%. However, we believe that on completion of the roadworks is going to benefit us significantly in terms of the growth of that store. The last update that we got from the authorities is that the roadwork should be completed by March, which is the end of this month. So we're keeping our fingers crossed that that will in fact happen. One of the bright stars for high-low is the performance of our Portmore store. You recall it was renovated and really a beautiful store. Their revenue is significantly up. And our Fairview store in Montego Bay is also up. So that those two stores, and including Manor Park, basically performed exceptionally well in terms of revenue, and that enabled high-low to show an increase in profits, increase in revenue overall. Another question for me, the nourishment. Nourishment in your stockholders report show that it has been a challenge for GK UK, and we are aware that it is one of the leading products. Yes, you are correct. Nourishment was down for 2017 versus 2016. We were very proactive in terms of putting in place measures to ensure that we regain our market position. So we increased our marketing and promotion. We increased our distribution through the cash and carry in a more efficient way. And we actually added a no sugar added nourishment. And I'm happy to say that for the first 2 months of 2018, nourishment is actually 19% over the previous year. So that would indicate, early days yet, but it would indicate that our strategic actions taken to turn around the performance of nourishment is working so far. Question for you, Mr. James. What is the estimated tax credit under URA that can be expected in 2018 and beyond? URA, Urban Renewal Tax Relief. That's a good question. Frank?
Thanks. As indicated, the urban renewal benefit that we have realized so far, we are about halfway through our eligible capital investments, and we have recognized $416 million in 2017. We expect to complete the building in 2018, which means we would recognize the full tax credits related to the construction in 2018. And so you can do the math there without my calling a specific figure. However, I would also make the point that the URA benefit is granted through to 2026. What implication does this have? So there are two. One, while based on accounting standards, we will recognize those benefits when the construction is completed, the cash benefit will be felt in the years to come, because we will be allowed to defer or actually reduce our tax liability up to 50% of our tax liability for the relevant entity each year until we have utilized those tax credits. So that will be a cash benefit. As I also mentioned, there is going to be a benefit once the building is operating, where we will get the rental income from that building tax-free through to 2026.
Okay, thank you very much, Frank. This is an interesting question for Donna. Will high-low deliver groceries by drones or pilot self-checkout like Amazon does with the Whole Foods? Well, a quick answer to that one is that we're not considering at this time delivering groceries by drones. I have been following the international news very closely, and I note that is a projection by some of retailers, but not at this time. Self-checkout, yes, we are looking at self-checkout. I expect to get an update certainly by the second half of this year in terms of self-checkout. I think with the right capital investment and the right training, self-checkout could actually be a win-win, both for our consumers and for high-low. Other question is, when is the new headquarters expected to be opened and fully operational? As I said in my opening comments, the building is expected to be finished by December 2018, and we are expected to move in by January 2019. And as I said, we are on track in terms of our budget. One of the things that you should expand on for the new corporate headquarters is that we're actually consolidating a number of rented space that we have in New Kingston. primarily in our financial services division, and they will be consolidated in our new headquarters in downtown Kingston. Another exciting project that we are working on for the new headquarters is that we're actually going to be setting up an innovation center in the corporate headquarters in a similar way as a Google and a Microsoft set up their own innovation center. So we are actually very excited about that. Other question, what accounts for the decrease year over year in both gross profit margin and profit before tax margin for the consolidated financials? Frank?
Thanks. We spoke to the impact of hurricane claims, and if you actually look at what you consider the gross profit line, that's before you reach other income. If you were to adjust for that, we would actually have been up. In fact, all segments have shown an improvement in margins with the exception of insurance. So that really is a direct result of the hurricane insurance claims in 2017.
Thanks. Don, I have taken note of your activity on Twitter. Can you believe that? Clearly, you're taking note of my activity on Twitter. What are your thoughts on social media for the GraceKennedy Group? I think that social media is here to stay. I think it's going to be the most powerful marketing tool for any organization in Jamaica and by extension throughout the world. This is something that we measure on a monthly basis in terms of our activity on social media. On the last check, I think it was a few weeks ago, we had over 1.5 million followers in terms of the group. And we expect that to increase exponentially going forward. So it's here to stay. It's a powerful marketing tool. I've been seeing Grace Foods on Instagram, and they have some very nice and attractive ads on Instagram. Can you give an update on the GK digitalization strategy? What is expected on this expenses and revenue? Thanks. As I said in my presentation, and the one that I'm most excited about is the GKFG mobile app. We're expecting that to be launched sometime in August, and it's actually going to change the landscape in terms of how we conduct our business in terms of financial services. I think that the millennials is going to really, really embrace this new technology where they can stay on their phone and practically do most, if not all, of their financial transactions. I did mention the Hilo online shopping portal. We're hoping that to be implemented again by the end of the year, where you can stay at home or in the comfort of your office and have your products delivered. You know, in the past, when you talk about digitalization, it was strategically as a CEO, a few years ago, we say it was nice to do. Well, I can tell you, it is a must to do now if you're going to stay relevant in this world. And I use out the remittance business as a prime example. So colleagues, the cash money services business, the remittances, the growth of that worldwide is about 2%. When you look at the digital growth in the remittance business, that is growing 25 to 30% annually. So what that is saying is that there's going to be a gradual shift of the traditional way of how you send money to be digitized. And that is why we have been investing a significant amount of time and money by developing new products along the digital platform. The first one is very exciting, wu.com, w.com. It's now in the pilot stage, and I expect that we will have a full rollout within the next few months. And you're going to be seeing, from a GraceKennedy Group's point of view, a number of services being offered over the digital platform. And I think that's going to be a key area of how this company stays relevant, how this company stays consumer-centric, and how we're going to continue to grow, not only in Jamaica, but throughout the world. Mr. James, I'm happy to see that the dividend went up significantly. Can you give us the rationale of that increase?
So we, as I mentioned, over the last few years, we have seen quite an increase in the GraceKennedy stock price. And the effect of that, while that's a positive, is that it reduces the dividend yield on the stock. So we have been looking at how to improve that dividend yield, and so we grew our dividend by 11% in 2017. The first dividend we have declared this year is a 33% increase over the dividend at the same time last year. And we continue to look for ways to enhance return to shareholders. At the same time, we continue to reinvest in our business because we see significant growth potential in a number of areas. Don mentioned digitalization as a key area that we think can generate both efficiencies as well as revenue growth opportunities. Financial inclusion is another area that we're going to be investing in heavily over the next few years, which we think has great potential for the group. And we continue to also invest in the efficiency of our manufacturing establishments, and as you have seen in our high-low and our retail outlets. So we balance the need for reinvestment in our business for growth as we see growth potential for our group. Acquisitions like consumer brands, acquisitions that we did in the US a few years ago. These are opportunities to truly grow the business while we also return to cash to our shareholders through improved dividends.
Thank you, Frank. Hi, DGW. I've heard that for a long time, Frank.
Somebody knows you from a long time
from
ago.
Florida. I see your products much more in the Florida area. How is your acquisition going? Great question, my friend, who didn't sign the document. But we had a fairly successful year. Revenue for our business in North America, well, in the USA market, was actually up US $7 million, which is very good. When you look at the numbers in terms of brand growth, both the Grace brand and the Lafayette brand is showing good growth. So we are extremely happy, and I've been very consistent since that acquisition in 2014 that our US business is going to be a game changer for the GraceKennedy Group. And it's very simple. I think if you look at the market dynamics in the USA, there's going to be a fusion between the Caribbean food market and the Hispanic food market. The Caribbean market is about $300 million US. The Hispanic food market is about $7 billion. So if you think of GraceKennedy in that market, we now have a very strong Hispanic brand, Lafayette, which we are going to be actually be relaunching this year with new branding and a new refresh. And we have the #1 Caribbean brand. So together, our objective is very, very clear. We want to break out in the US market to be #2 in the US market behind Goya. And I would say that we are making very good progress. I hope for those of you who are listening also from North America and the USA, we have had a big success in the launch of our patties. The growth for our patties has been significant. You can now get the patties in Walmart and Target. Beef patties, mild and spicy, and our chicken patties. And again, the growth in that product has been significant. Don, I've been studying your numbers for quite a few years, and we know that the remittance business is now accounting for 50% or over 50% of your profits. With compliance being much stronger, how is that being dealt with? Thank you very much, and that's a really, really, really good question. Let me say this. GraceKennedy, we operate, and Western Union, a zero tolerance as it relates to any suspicious transactions over our network, and that is with a full stop. You'll recall that in 2013, we suspended a number of our agents. We did our due diligence, we changed our systems, and we by far reduced the suspicious transactions significantly. Again, in 2017, we did another refresh, looked at our systems, did due diligence. We closed a few agents. Remember, we have 143 agent locations, and we closed 10. And the 10 is now open. So we will continue to invest in human resources and technology to ensure that our system is not abused. At the end of the day, we believe very strongly that compliance is going to be a competitive advantage for the GraceKennedy Group, and our remittance business through digital expansion, through expansion through our agents, is going to continue to grow significantly. Is the company, Frankie, why don't you take this one? Is the company planning to fully embrace blockchain technology in any serious way in its operation?
Good. Thanks for that question. We are actually looking at the whole matter of blockchain technology, and in that regard, I want us to distinguish between blockchain and cryptocurrencies, because cryptocurrencies are only one application of blockchain. From our research on blockchain, there are many applications of blockchain, and that is something that we will be looking into to see how it can either improve our efficiency, help us to deliver better to customers, manage our internal matters, as well as our relationships with our suppliers and stakeholders. So we do think there are opportunities for blockchain. Cryptocurrency would have a number of regulatory implications, which we would have to be guided by our regulators on that matter. But we will be exploring the matter of blockchain.
I'm getting a wrap-up signal, but there are a few questions coming through. Don, how is GKVR doing? Very, very quickly. As you know, GKVR is 2 years old. We have 125,000 members. We're going to be adding some new benefits to GKVR for 2018. But on a whole, we are pleased. 125,000 members is quite good. And we think the growth in the membership will continue. What we are trying to do is to add other benefits through other related GraceKennedy partners. As you know, it was really focused on the GraceKennedy subsidiaries initially, but we're going to open it up wider now. So there are going to be other benefits by using GKVR. Okay, folks, I think we have just about run out of time. Can I, let me just try and find my paper here to write. Can I, and I know time has been short and we have had a number of questions still unanswered. Can I remind, and we're very, very willing and able to answer more questions. You can email them to us, gkinvestor@gkco.com, gkinvestor@gkco.com, or you can text us at 876-809-1121 or 876-809-0464. Once again, we thank you very, very much for joining the GraceKennedy Group for this investors briefing. As you have heard from Frank and myself, we feel very, very positive about 2018. And I'll say the best is yet to come for this great company. Thank you very much.